Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, and Jim, here we are together. It's Friday. We've got listeners out there and a very interesting market.
And as usual, we like to answer listener questions. Our first one comes from, you say Cecil, I call him Cecil. Someday we'll get the right pronunciation.
Yeah.
He writes, "Hi Bob, I'm under the impression you are in the deflationist camp. Are you?"
Well, what it is once this boom is over, the financial boom is over, which we thought that it could be sometime this year, perhaps sometime towards the middle of the year, when everything's going straight up, which it is. So once the speculation in financial assets fails, then we go into a post-bubble contraction. So me, I'm not a deflationist, I'm not an inflationist, I'm a historian.
Bob, if we do go into deflation, what will it look like? Will we see drastic reductions in the price of things besides stocks like housing, food, energy? How much of a percentage do you think those areas will decline?
It's hard to put a percent on it, but it would be initially a cyclical, a recession with prices starting to go down, starting to weaken, and this could prevail for some time. Previous post-bubble deflations have lasted about 20 years, with the business cycle coming and going, the 3 to 4 year business cycle. So, but within a regime of weak prices, for example, ages ago I did come across a index for England on farmland values from the top of the bubble in 1873 to the bottom of that Great Depression in 1895, and virtually every year it was down. Memory's not so good on this one, but let's say the index was at 58 in 1873, and by 1895 it was down to something like 38, just rough recollection. So it's amazing how one can go from soaring inflation in tangible assets, then inflation in financial assets with a rise in commodity prices, and then once the inflation in financial assets is over, then it goes into a contraction. Good question.
From Kathleen, and we know our usual listener Kathleen loves to mix music into her questions, so Kathleen's music-oriented question today. Hello, Jim and Bob. It looks like the markets have started doing the hustle. You remember that from the 70s. Also remember doing the bump. Elon Musk on Saturday Night Live jokingly said that the crypto Dogecoin is a hustle. It crashed the next day. By Wednesday, crypto advocate Musk said he would no longer accept Bitcoin or Dogecoin as payments for Tesla cars, stating that the crypto mining was a drain on the electric grid. That reminds me of the top of the charts disco tune in the summer of 1975 called The Hustle. Its singular lyric was "Do the Hustle." Bob, do you think these extreme market valuations are run-of-the-mill euphoria, or are these actually market manipulators giving us the hustle?
I think some of that by Musk might have been taking advantage of the market. We've seen that done by Warren Buffett, where he would quietly position silver, this is a long time ago, and then it would eventually come out in the annual report or quarterly that they had a silver position, he'd be interviewed and talked about it, everybody would buy silver and then he would sell. So we don't know if Musk is taking advantage of the market and his announcements. But my old trading floor cynic comes in and thinks that he probably took a little advantage of his announcement. He might have reduced his position before coming out with a negative comment. So fascinating to watch.
A question from Justin in Berkeley, California. Hi, Bob. I once read that the Fed doesn't manage inflation, but they do manage inflation expectations. If the street and the Fed jawbone enough about inflation, isn't this just convenient cover fire for companies to increase the cost of their products to make up for the lower sales volume, therefore creating CPI inflation? P.S. How is the Alfa Romeo?
Justin, nice to remember about that one. About the Alfa, I had 3 collector's cars and sold the last one a year or so ago. It was getting just too much to handle, even though they were all virtually concourse class, but they still take some fussing with them. So, unfortunately, I'm out of Alphas. Now, about inflation expectations, this has got to be one of the fakest things in economics. The establishment really believes that if the Fed is not easing and providing accommodation or whatever, then you're going to have permanent deflation. But they don't want to be seen to cause a burst of inflation when on a business cycle you get rising prices. So they, in their minds, their constant easing and constant injection of credit does not cause currency depreciation and with that inflation. So how they make the next step is that then when inflation comes, it's due to the public's inflation expectations. Now I'm telling our listeners, you got to have a PhD in tautology to kind of accept that kind of reasoning. It's absolute nonsense. And what you have on every business cycle, you will get a rise in prices as it concludes. And then when you're in a constant overstimulation of credit by the Federal Reserve, then over 100 years you'll get depreciation such that the dollar only has about 3% of its purchasing power, and then it had in 1913 when the Fed was incorporated. So, yeah, they're not. The Fed is in a really awkward place because for a large part of the last decade, they were deciding that there was not enough inflation. I mean, man, they talked about it all the time. But what you're looking at is that when you're in a financial mania, it's financial assets that get inflated. And then as that business cycle concludes, you get a rise in commodity prices. So the last time this happened was in the 1920s, when the 1920 boom in commodities globally was amazing, huge. For example, the U.S. CPI inflation got up to plus 24% in 1920, and in 1929 it was something like minus 16. So in the mid-20s, the Fed was very concerned about pricing power, so they were fearful that there wasn't enough inflation. So the Fed was easy during the 1920s, not understanding the consequences of a huge inflation in financial assets, which then came about. The stock market ran its course, became over-speculated in, and then you went into the lengthy post-bubble deflation and credit contraction. So the Fed spokesmen are all over the place on the subject. The main thing to understand, Justin, is that they don't understand how the financial markets work over time. they cannot distinguish the difference between inflation in tangible assets and then the inflation in financial assets. And since 1720, every big inflation in financial assets, i.e. stock prices, once it's over, man, you go into a lengthy contraction. And I see no reason why it would change. So far, we're on track. You're getting terrific speculation in financial assets and accompanied by a boom in commodities. Now, on our work on corn, soybeans, lumber, and copper, these have all recently accomplished tremendous technical excesses. So the move is essentially over, and the notion that 1970s inflation is going to come back is likely in the market, and it ain't going to come back because I think we're going to go into a period of weak prices. Now, here's another thing on commodities, is that you can have a seasonal high for copper in July, seasonal high for lumber in June, and sometimes you don't quite make it to these things, but you know that in the summer some of these things are going to be strong, and then when they get technically overdone, that's what we do. We advise our subscribers as those items were peaking, and they were terrific. We were getting what we call trifecta sells on them, whereby you've got the upside exhaustion signal on the monthly, on the weekly, and on the daily, and they don't happen all that often. So I think we're at an important high for commodity prices and financial assets.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. One of the headlines that caught your eye today, iron ore turns very, very hot.
Yeah, that was a good headline with a very, very in it. And iron ore has gone straight up. There was another one about copper producers suffering a shortage of sulfuric acid, which is necessary in the process. And the reason why there's a shortage of sulfur was because a lot of petroleum production and refining was shut down last year, and then they get sulfur as a byproduct from petroleum. So interesting how these things roll around.
Yield-starved investors are snapping up municipal bonds. Is that a good move?
I don't think so. This is a highly dangerous situation. And also, it's very immoral with the Federal Reserve on its mania to have artificially low interest rates. And then that distorts the investment opportunities that are out there. And you've got pension funds and casualty insurers and life insurers that all have certain returns that they have to make. So they should be able to get a decent return from investment-grade bonds, but they can't because the Fed is crazy. So then they're having to reach for yield and buy garbage to get the return numbers they need. Now, these return numbers are determined by the actuaries. So the casualty life insurers, they just have to get certain returns. And then talk about, senior citizens who, for reasons of prudence, are perhaps reducing their exposure in equities and then buying yield. But there is no yield. But in order to get some yield, they got to buy junk. So this is both the policy by the central bankers is, number one, stupid, and the other, in result, it's unethical, immoral, whatever you want to call it. And I think there will be a great reckoning ahead on the next contraction when it comes in.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, a couple of more headlines that caught your attention. One of them, Taiwan stock crash dangers showing the risk of too much leverage.
Oh, yeah. They had a mighty whack to their stock market. The major indexes got hit just wham, just like that. And so this is where the headlines that we've discussed about the boom, of which iron ore is very, very hot, those are part of the old. This is old, is the boom is maturing, so that's the old story. And the new stories that are just starting to emerge are one like this about the Taiwan stock crash pointing out the dangers of too much leverage. And then there was another one as well.
Yes, this headline, China records record high bond defaults.
Yeah, that's defaults. That's where they stop payment. So then this is now suddenly a record high number of bond that are stopping payment, unable to cover their interest rates and stuff like that. So that then is one. There's two stories that are detailing the next big thing. And we know that in every bubble, in the past, where they peaked, occurred in London, they peaked in May or June, and then dithered around the summer, and then all crashed in the fall. And then we had a nice one in January, whereby noticed that once and this has to do with margin, so we'll talk about it, when the New York Stock Exchange margin reaches a certain rate of growth, then you can have the peak of the stock market 6 months later, around 6 months later. So that rate of growth was reached in November. Count out 6 and you get to May. So here is one count in this stock market cycle. And then that's also matching with a long history of the good times peaking in May or June, and then the also very long history of bad times being discovered in the fall. So the line I like to use is the stock market up when it should be? Yeah, into May or June. Yes, it is. Then the next question is, are there signs of speculation? Ooh, yeah. Very, very hot iron ore prices. Plus, we've got our in-house technical measures on the speculation, and it's getting very intense. And then a third question is, how sound is the bullish story behind the move? And the bullish story is just that it's been going straight up, and it will continue to go straight up. The economy is booming. It's got past the artificial hit to employment due to the COVID scare. And this is, I think, just part of the account. You've got a booming stock market. You've had booming economies. Commodities. And you had a firm boom in the economy. So this looks like a natural peak in here, and I think these, the way I've been emphasizing, where you take some headlines that show the boom, that's the maturing story, and then you have a couple of small headlines about sudden defaults and things like that, which then is the next story, and this could become more frequently reported after August. So it's going to be extremely interesting summer. and extremely interesting after August, Jim.
Bob, thank you so much for being on the show.
Well, good to be with you and good to be with our listeners, and it's always good to get the questions from out there. So thanks again.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howestreet.com. Our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.